Hi, this is Dan Kelly. Welcome to today's conversation about bonds payable transactions. So bond transactions are very similar to notes in that somebody is borrowing money, in this case a company, but instead of borrowing it from one party, like a bank, bond transactions allow companies to borrow from multiple parties, like individual investors or institutional investors, but many parties at one time. So those parties loan money to the company, and in exchange, these people are called the loaners. In exchange, the borrower issues a corporate bond to the investors. So the investors, the loaners, loan cash to the company, the borrower, and in exchange they get a piece of paper similar to a note saying, I will pay you back with interest. So bonds allow companies to borrow large sums of money from multiple parties. So instead of going to a bank and asking for a larger loan and the bank taking on that risk, which is not likely to happen, companies can go to individual investors and say, can I borrow $1,000 from you and $1,000 from you and $1,000 from you, and so on. Just like notes, interest is required and payment is dependent upon the terms of the bond. And there are really three key variables in the bond contract: the face value of the bond, which is the same thing as the principal amount, the annual interest rate, and the maturity date of the bond. Again, very similar to notes. So bond pricing is very dependent upon the interest rate on the bond and how it relates to what the market is offering for similar bonds. So if say IBM were to issue bonds, IBM's a pretty solid company, has a pretty solid credit rating. If they offer 6% on their bonds and they walk out into the market and realize that the market is offering 8% on similar bonds, IBM is going to have to issue these bonds at a discount. The market is offering more return or interest to investors, so in order to entice investors, IBM will have to offer a discount on the bond, meaning put it on sale. If the market is offering 6%, then the bond will be sold at face value because everything is fair. And if the market happens to be offering less, such as 4%, IBM would be able to charge a premium because it has something that investors would like: more return for the same amount of risk. So the bond pricing is put on an index. Bonds that are sold at 100 are sold at 100% of their face value or par. Bonds that are sold above 100, such as 105, are sold at a premium because they're sold at 105% of their face value. And bonds that are sold for less than 100, such as 95, are sold for 95% of their face value. They're sold at a discount. So if the bond price was, say, 102, it's sold at 102% of its face value. If the bond price is 91, it's sold at 91% of its face value. That's all that means. Okay, the interest calculation is the same as notes. We need to know the interest rate, the dates, and the principal. Most bonds have interest that's due every year. Some of them certainly have them due every 6 months. The formula will remain the same: principal times rate times time. The rate is always annual, and we'll adjust for any changes or fractions of the year by using the time variable. Okay, so again, the rate is always annual. We adjust for fractions of the year by using the time variable. Okay, so let's look at an example. ABC issues $100,000 in bonds on 1/1/16. The 10-year bonds have a stated rate of 6%, and because the market is also offering 6%, the bonds are sold at par. Interest is due annually, and ABC's year end is 12/31. Let's take a look at the entries. So when the bonds are issued, very similar to notes: debit cash, credit bonds payable instead of notes payable. When the interest is paid at the end of the year, we're simply going to calculate it by taking $100,000 times 6% times 12/12. That's $6,000. Debit interest expense, credit cash. That will be made every year for 10 years. And then when the bond is repaid, we simply flip the original entry by debiting bond payable and crediting cash. So as you can see, these are very similar to notes, assuming that the bonds are sold at par value, or what we also call their face value. So some final thoughts on bonds. Again, they allow companies to borrow large sums of money from many investors. Governments issue bonds. Corporations issue bonds. A lot of different entities issue bonds. Okay. When they are issued at face value, we treat them just like notes, except we use the word bonds instead of notes. But when they're issued above or below face value, the accounting is much more complex, and this requires the amortization of the bond premium or discount. So you might need to know more about that. If I've posted a bond problem video, then you probably ought to look at it. If you don't see the bond problem video, this is good enough for you. I hope this helps. If you have any questions, please feel free to reach out, and I thank you for your time.